Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Matt Bartolini, head of Spider Americas Research at State Street Global Advisors. We are talking about the market outlook and best investing strategies for 2023. Matt, welcome back. Great to have you on the show.
Yeah, thanks for having me back. Excited to talk about the outlook for 2023.
Sure. So it's been a bumpy ride for investors this year, and thankfully it is almost over. So now investors are looking forward to 2023. And in fact, this is a big week for markets. So we got a cooler than expected CPI report yesterday. So it seems that the Fed's aggressive tightening campaign against inflation is working, but of course there's still a long way to go. And just now we got the announcement from the Fed. They hiked the rates by 50 basis points, which was as expected, but they signaled more rate hikes next year. So that is why stocks are down after that announcement. So I wanted to start with the State Street's market outlook for 2023. Tell us what your crystal ball is telling you. What does 2023 have in store for investors?
Well, I think it's going to be a really great big balancing act for the broader market. And I think what we're going to find is some of the trends we witnessed in 2022 carrying over into 2023 quite initially, with a hope that there is a somewhat of a pivot, which is largely becoming quite an overused term, somewhere in the back half of 2023. So I think initially continue to expect some outsized volatility as macro headlines dominate investor sentiment. Continue to expect higher interest rates, which then will put pressure on funding, meaning companies will continue to have to raise capital at higher rates. That'll have an impact on margins. Inflation will be declining, but still significantly elevated. I think the one thing that we have pointed to, to those that are, sort of ringing the all clear sign on inflation, just given that we've had some weaker than expected prints, is that in the 1980s, when inflation was this high, it took over 15 months for the year-over-year number to come back to anything that would resemble somewhat normal. So I think you can expect that too. In that higher inflationary environment, that's also going to have an impact on margins, because what was not softening in the inflation print from this past week was services inflation. So wages, the labor market remains extremely tight. That's going to continue to impact margins. So what's that going to do? That's going to continue to impact bottom line growth. So earnings per share estimates are going to continue to be revised lower. We've already seen 2023 estimates be revised significantly lower in this past quarter, very much more than we've seen in other prior quarters before Q1. I think there's a pretty good expectation that those numbers could be ratcheted down further, because there are some sectors, like consumer discretionary being one of them, that are reporting positive margin, or there are analysts that are forecasting positive margin contribution for 2023, which is really hard for me to fathom given how negative margins have contributed to growth in that space, but also just what we see from a services perspective. So long story short is we would expect to see a little bit more of the same volatility, uneven market returns, sluggish fundamental and economic growth combined with higher interest rates. Yet in the back half, as the Fed's rate hikes finally work through the economy, you start to see them pulling off their sort of aggressive tone. You start to see analysts repricing that into forward-looking estimates of growth. I think EPS revisions will find a bottom, and then there's a hope that the market would heal from that point on, and there'd be sort of brighter horizons ahead. But it is going to be that balancing act, that sort of hope versus reality of what we've been talking about. The hope that things get better versus the reality of that we're likely to endure a recession in 2023, as it were.
So that brings us to positioning the portfolios for 2023, and investors are, of course, wondering where they should place their bets for the new year. And your research piece, it laid out 3 investment themes for 2023. So maybe we could go through those themes one by one. So the first one is about playing offense and defense with dividend players. So let's start with that.
Yeah, and I think that really speaks to just a broader view, is that, you're going to continue to balance this idea of recessionary versus repair, right? We're going to have the recessionary headlines, but ultimately, when the Fed does pull off their aggressiveness, the repair of the economy will come in because we won't have as higher rates. I mean, the expectations that we saw today that came out is that 2023 peak in rates around 5.1%, and then a cut in 2024 to around, I think, 4%. So it's about 100 basis points cuts the market is expecting a year out from now, which should be growth positive. And even the forward guidance, which I think a lot of people lose sight of as a Fed policy tool. Everyone sort of focuses on interest rates and quantitative easing / tightening as the 2 main ways to affect policy. But forward guidance, that is going to be the driver, in my view, of market sentiment, rates, markets, anything. And I think what you'll see is that forward guidance will become more dovish, starting probably sometime around the March-May time period. And then that is going to lead to some positive upside surprises. So we want to have this idea of playing, being defensive, being cyclical, being, focused on sort of that flexibility to pivot quickly, but also the durability to handle some of the pain we're likely to witness in terms of, sluggish earnings growth, significant number of firms no longer beating estimates. We saw that this past quarter. But also, firms are not beating estimates that have already been lowered. And we continue to have outsized, macro-led volatility, just given the significant geopolitical risks that are going on throughout the world. Even today with Peru calling in their National Guard, and given the unrest in their local region, and obviously still have what's going on in Russia and Ukraine. So we like this idea of playing offense and defense with dividend payers, because if there is going to be a concern around the fundamental backstop to the markets, right, that idea of positive earnings growth and return of value to shareholders, that dividend payment is a return of value. So we like the idea of getting that dividend, having that more quality basis to the underlying firm's exposure, because if you're able to pay a dividend, you clearly they're having positive earnings. Habitually, we have seen firms that are high dividend paying firms. So we went back and we looked at, using FAMA French data, we compared high dividend stocks to low dividend stocks all the way back to the 60s. When we found out that high dividend equities have demonstrated consistent outperformance as they outpaced low dividend paying firms and the broader market in 11 out of the last 13 bear markets. So I think that's really important. And the 2 that they didn't were pretty systemic bear markets that are brought on by exogenous events, the global financial crisis, obviously the impairment of the banking system, and then the COVID-19 pandemic with the impairment of the public health system. So we like this idea of dividends because it gives you this aspect of defensiveness, but also at the same time, dividends are not just wholesome defensive equities. There is some upside, some cyclical upside to them as well, because they're closely related to the value factor, and value has a association with early cyclical type market environments. But also, when we decompose the underlying sector exposures, we can see that roughly 40% of a dividend, S&P 500 high dividend strategy is to defensive sector exposures. So 60% are to non-defensives. That 40% is a little bit higher in the market, but it's well below what we see for, say, S&P 500 low volatility funds, which are around 60% allocated to the defensive sector. So we like dividends because you can kind of play both sides of that fence. You can be defensively positioned, focus on firms that have a proven track record of continuing to provide shareholder return in terms of dividend payments. Meanwhile, you're still not holistically all defensive because dividend exposures have some cyclicality to them as well.
Very interesting. And dividend paying stocks and ETFs have been very popular with investors this year. And in fact, most of them have done much better than the broader indexes as well. And in terms of implementation ideas, I saw that your note mentions three dividend ETFs. Now, one of these two are US equity, dividend equity ETFs, and the third one is international. And between the US dividend ETFs, there are some significant differences. One focuses on highest dividend yielding companies, and the other one looks at both dividend yields as well as the consistency of increasing dividends. So dividend growth as well as yield. So tell us more about these two ETFs and also about the international product, why it is time to look at international dividend payers now.
Yeah, so SDY, the Spider S&P Dividend ETF, that's a fund that seeks to track an index that focuses on companies that have consistently increased their dividend for 20 consecutive years. So while dividend yield as a style is a value screen, because these firms have shown a proven track record of continuing to return value to shareholders for 20 consecutive years, obviously they've seen different economic cycles and can be perhaps better able to withstand market turmoil as well as economic turmoil. That layers in an aspect of quality to it. So for those that are really trying to thread the needle and balance out the portfolio on both sides of offensive, defensive, SDY is something from that effect, because you get that value, you get that quality, you get some defensiveness. For SPY-D, it's within large cap S&P 500, those firms, blue chip type names, but it's the highest 80 yielding dividend stocks. So you're going to get a stronger value screen from that perspective, but you're still going to be, in those large cap blue chip type environment. And then, so that would be SPY-D. Then the international one's DWX, and that's the 100 highest yielding international stocks that have passed certain fundamental sustainability and earnings growth screens. So is that the earnings growth screens and sustainability are not as stringent as the 20-year screen on SDY, but there is an aspect of trying to prove out that these are not just yield traps. And DWX allows you to step into the international market, but perhaps with a little bit lesser volatility profile than traditional broad beta. And we generally do like the international market. So regionally, if we're going to say, what market environment, what market exposure would you, be overweight or underweight? Right now in our tactical asset allocation portfolios, we have an overweight into international developed equities, specifically into Asia Pacific. DWX has a pretty high allocation to Asia Pacific. US slight underweight, EM slight underweight as well. And part of the overweight on the international developed is earnings trends are a little bit better there than the rest of the world. And because international developed stocks have really not done well for the better part of probably like 5 years relative to the US, there's a pretty good valuation argument to be made just for the region alone.
Right. International stocks do look attractive in terms of valuation. Another area which looks quite attractive is, areas like small caps, chips, etc. And you talk about them under the second theme, which is finding opportunities in discarded markets. So chip stocks are also always very popular with investors, and they were beaten down this year because of fears about global economic growth and also these continued supply chain disruptions. Now, many rebounded in the past few weeks, particularly after we started seeing some of these cooler than expected inflation reports. And also many of these companies also reported better than feared results. So many investors have been wondering whether it is time to, start buying back those beaten down chip stocks and ETFs and also small caps. So tell us about your next thing, finding opportunities in discarded markets, and then we can talk about the ETFs.
Yeah, so the whole theme here about finding opportunities in discarded markets is really just reflecting on the preponderance of pain that portfolios have felt this year, particularly how both stocks and bonds on a global basis fell into bear markets at the same time, something that has never happened before. And if you even look at, going back to the 1970s, using the S&P 500 and U.S. Treasuries, and you were rolling 12-month returns, in only 13 out of 570 some odd periods. Only 13 of those were both stocks and bonds negative at the same time. 8 of those have occurred in 2022. So it hasn't been great from a return perspective. So as a result of that, there's some markets that have been, thrown out, to the trash heap that perhaps are, a true value opportunity and are trading well below their intrinsic value. So one of the areas that we like are U.S. small caps. When we look at relative valuations and we look at it through a 5-factor model, and then we also compare it not only on an absolute basis relative to small caps' own history, but then relative to the global equity market as represented by the MSCI ACWI index, we see that U.S. small caps, compared to EM or Asia Pacific equities or U.S. mid caps, EFA, Europe, U.S. large cap growth and value, U.S. small caps on a percentile basis rank as the cheapest on both an absolute and a relative perspective. So purely from a value play, that is quite an opportunity. And then when we look at the marketplace from a growth perspective, the other aspect here is that EM is cheap too, but EM, their growth expectations have been ratcheted significantly lower. For 2022, expected earnings growth is forecasted to be significantly negative, basically an 11% decline. 2022 earnings growth for small caps is actually projected to be positive and has actually been revised higher for right now than what it was at the start of the year. And 2023 earnings, while they've been lowered like everything else, they're still projecting around about 4% growth. So still strong from that perspective. I think one of the reasons why we saw significant negative returns in 2022 for small caps is that they're risky. And when you look at a correlation of small cap returns to high beta stock returns, that risk aversion rationale sort of really is reinforced, because in 2022, small caps registered their highest average 30-day correlation to high beta stocks since 2011. So simply put, anything with a whiff of risk was seemingly discarded this year. I think small caps fit the bill. The other area that we like is semiconductors. Semiconductors are a long duration growth equity exposure because high growth allocated firms, when we see interest rates go up, the discount model that you're using to value those cash flows changes and the PE is going to be ratcheted lower. As a result of that, semiconductors, they both, they trade relative to the S&P 500 in the historical 20th percentile based on that sort of 5-factor screen. The broader tech sector is in the 80th percentile. So a pretty differentiated profile to the broader tech sector. And our view here is, if there's a lot of ifs that have to take place. So if there's a positive growth surprise because the Fed pauses their aggressive policy, if China reopens where you have significant spending in that local region, and that's going to boost global GDP, that could create an upside surprise to semiconductors because a lot of negativity has been baked in. If we look at the broader S&P 500, the semiconductor sub-industry has been the one industry within the tech sector that's had the most significantly negative revisions this year for next year's growth. So I think there's a perceived bottom there from fundamental sentiment. And I think if there's any positive surprises, given the attractive valuation starting point, we could see it bounce higher. The other part is that if the Fed pauses on their aggressive policy, that's likely to have a sort of a negative effect to the dollar that could lead to a dollar weakening. And 80% of semiconductor firms in the U.S. get revenue from outside the U.S. So an upside surprise on growth stemming from a policy pivot and a weaker U.S. dollar that mean reverts off the 20-year peaks could counterbalance the headwinds for semiconductor sentiment and the recent trend of softer but still positive sales. So that's why we like semis, is sort of if we see that hope of a stronger growth environment because of less restrictive policies, both from a monetary policy perspective in the U.S., but also zero COVID policy in China, you could see a reality come to fruition of stronger returns for semiconductors. Because, unlike some of the other tech sectors, the semiconductor sub-industry has the largest percentage of firms with positive earnings per share over the past 12 months. And, they're going to start off a base of profitability, where say software is, there's a lot of unprofitable firms in that. So we do like semiconductors as those discarded markets.
Interesting areas, definitely. And in terms of implementation ideas, the ETFs that investors could look at are the SPDR S&P Semiconductor ETF, XSD, which is an equal weighted ETF, and for small caps, SPDR Portfolio S&P 600 Small Cap ETF, SPSM, which is a market cap weighted ETF tracking the S&P 600 Small Cap Index. Anything else investors should know about these two ETFs?
Well, for XSD, it seeks to follow an index that uses a modified equal weighting scheme. So from that perspective, we're able to mitigate some of the stock-specific risk, which obviously in semiconductors, that can be quite significant. If we look at some of the names within the index, some high profile players like a NVIDIA, there could be more, say, fundamental weakness in one firm versus the other. So having a modified equal weighted approach can really counteract some of that stock specific risk and perhaps seek to get a more pure exposure to the industry effects, right? So the overall industry, and not have just one or two single stocks driving returns because of some idiosyncratic event within their own book of business. So, again, that's one of our sort of firm beliefs, is that when you get into this more granular, narrow area, you don't want a market cap weight because you're going to have one or two names just really drive returns. We saw this with aerospace a few years ago with Boeing. Our aerospace and defense fund is equal weighted. Competitors are not. Divergence of returns from that perspective. So here you're not making so much a bet on the stocks, you're making a bet on the industries, with the stocks within that industry, and that's why we like the equal weighted approach. So that would be the one big clarification or aspect of specificity there from an implementation perspective.
Yeah, I like the equal weighting approach. And in full disclosure, I own this ETF in the ETF investor portfolio that I manage. Now let's talk about bonds, because this was a very bad year for bonds. But now many investors are looking at bonds and fixed income ETFs again, because yields, which are at levels which were not seen since the global financial crisis, and also it appears that the most aggressive part of the Fed's tightening campaign may be over. They will start raising rates, but not at the pace at which they did in the past few months. So you discuss bonds under your theme, managing yield and duration in the hunt for total return. Tell us about that.
Yeah, so it's part of it's just trying to take what the Fed has given you. Today they came out, they raised 50 basis points. That was pretty well forecasted. And we're likely to see another 50 basis point of rate hikes, 25 each at the first two meetings of 2023. So that's going to continue to push the front end of the curve up. And at the front end of the curve, there's some really attractive opportunities to balance the yield and duration to get a stronger, perhaps, total return. And, for instance, the 1 to 3 year corporate bonds, they have a yield to worst right now that is above 5%. And if we look at that relative to the earnings yield on the S&P 500, which is 5%, you're basically able to get a cash flow generation yield in bonds on par with stocks. Yet you're doing it with 80% less volatility because you're just owning 1 to 3 year investment grade corporate bonds. And the interesting thing is that that elevated yield, which is only likely to move higher because the Fed they have just absolute control of the front end, and 1 to 3 year corporate bonds are in the front end of the curve. And that yield, that increase in yield, is not a result of any sort of foregone or concluded increased rate risk or credit risk. If we look at the duration profile of 1 to 3 year corporate bonds, the duration profile, because of the maturity band they play in, is essentially on par with the 20-year average. Similarly, if we look at option adjusted spreads are actually tighter than average. They're 75 basis points on average. They're around 95 basis points. So you basically can get a over 5% yield, something that has been never outside of the great financial crisis you have not been able to get over 5% yield on 1 to 3 year investment grade corporate bonds. So, and of course, back in the financial crisis, the reason why you were able to get that 5% yield is because of increased credit risk because of what was going on from a sort of economics perspective. So if we go back, you get a 5% yield, which is on par with the earnings yield of the S&P 500, yet you are not taking on any more credit or duration risk than anyone would have in the past 20 years. And this yield is likely to move higher as a result of the Fed pushing up interest rates on the short end of the curve. Now, it's also our view that this level of inversion on the yield curve, we're at record levels, the inversion of the yield curve is likely to slow and probably, still be inverted, but not as, right? So it would steepen a bit. And I think from that perspective, you're likely to still see troubling returns in bonds because you're likely to see higher rates. It's just that the back end of the curve is going to move up a little bit more than the front end, because I think to some extent the perceived notion of slowing policy will also be growth positive, which has an impact on the long end of the curve. But honestly, I think the big takeaway is that areas like 1 to 3 year investment grade corporate bonds have created or are offering a potential source of total return that we haven't seen in years or rarely have ever seen, and it is not a result of increased risks relative to the last 20 years.
Yeah, I totally agree with you. The short end of the curve looks really attractive because the yields are so juicy as of now, and investors take very low duration risk as well. Now, in terms of implementation ideas, I saw that your note has recommended 2 shorter duration bond ETFs. And the third one is an actively managed ETF, which invests across all maturities and all credit qualities. Tell us about these 3 ETFs.
Yeah, so the first one is our 3 to 12 month T-bill ETF, BILS, BILS. And it does what it says on the tin. It focuses on bonds or in this case, bills, in a 3 to 12 month treasury market. And, from that perspective, they're going to feel the rate hikes, the quickest because they're so short. They're so short on the end of the curve. And, like I said earlier, you're getting a 5% yield in 1 to 3 investment grade corporate bonds. In 3 to 12 month T-bills, as of today, it's a 4.5% yield, but only 0.4 years of duration. And that's quite significant because if we look out the rest of the yield curve, this 3 to 12 month space is the highest yielding area of the yield curve. It yields more in the 1 to 3 year, 3 to 5, 5 to 7, 7, 10, 10 plus because of that inversion. So this is a pretty attractive yield per unit of duration play within treasuries alone. And we do know that the Fed is going to be hiking rates. Even Powell said today, exact quote, Fed still has way to go. So expect higher rates. The other one is SPSB. So our SPDR portfolio, 1 to 3 year investment grade corporate bond ETF. Again, not to belabor the point, it focuses on that 1 to 3 year space, which I think is one of the more opportunistic areas right now, just given the yields, the level of risk you're taking, and then the relative value to broad-based U.S. stocks, from a yield perspective, but the volatility of that yield, or volatility profile of the underlying bonds that make up the yield is much less than stocks. And then the last one is TOTL. It's actively managed by Double Line. It's an intermediate core fund, focuses, it allocates across both interest rate and credit sensitive segments. And I think that's really important because in 2023, as I said at the top of this, we're going to be witnessing some of the same risks to the market, and being able to balance both rate and credit risks, I think, could be really important because the credit markets, I think, are going to be inherently challenged, much like equity markets, because sentiment is so weak there. We've seen continued rating downgrades. They're likely to see an increase in defaults. So I think an active approach in your core, I think, makes much more sense than taking a pure passive approach, because there are going to be some credit, weakening events in 2023.
All interesting picks. Now, let's switch gears a little bit and talk about the record-breaking year it has been for the US ETF industry. And despite all these challenges and continued market turmoil, US-listed ETFs remain on track for second highest annual inflows on record. And more than 400 new ETFs have been launched this year, which is not which is lower compared to last year, but still very impressive. And I saw a recent note by you where you highlighted 4 more areas where it has been a record-breaking year for ETFs. Tell us about that.
Yeah, so that was a blog post we just posted. I think might have been even this Monday or Tuesday of this week. It focuses on the trading volumes that we have seen, and it goes back to this idea of fund flows are sort of a summation statistic, right? They are a result of all the things that has happened before that. So someone needs to make a trade. That buying behavior outstrips the supply in the secondary market, and as a result, that flows to the primary market. But again, not every single trade is reflected in the primary market. There's a lot of trades that go into the secondary market, and as a result of that, you have in this year, there are 4 charts that we identified with record-breaking usage. So this sort of goes back to the conundrum of are fund flows indicative of usage of ETFs? They are. But are secondary trading volumes more reflective of overall usage of every person that has tried to transact either a buy or sell within the ETF? And I think the secondary market volume is more telling of overall usage, while the fund flows are more reflective of that primary market usage. And there's a little bit of distinction between that. But overall, we saw trading volumes hit records. So in 2022, there was over 40 trillion of ETF trading volume. That is a record. We also saw records within both just not just ETFs overall, but within that it was equity funds, fixed income funds, commodity funds. All of those had record trading volumes in 2022. So it wasn't just one specific area. The one thing that I thought was really interesting is that ETFs made up 32% of all exchange volume in 2022. So anything that trades on a New York Stock Exchange, NASDAQ, anything listed in the US made up 32%. That's the highest annual percentage in the last 10 years, and it reverts a trend that we saw where single stocks were becoming more heavily traded because of more retail participation in some of those meme stocks. And as we saw a report from JP Morgan, retail single stock trading is down around 40%. And a lot of individuals gravitated towards using ETFs to maybe express those macro themes, but also just ongoing portfolio construction. So large trades, large proportion of overall trading, a large number of trades, which I think is really helpful. So on average, in a given day, ETFs had 12.3 million trades executed on them. That is a significant increase from prior average. So basically a 50% increase from the prior year, which is about 7.6 million trades, which for me, it highlights sort of 2 things: strong depth of activity, which means elevated volumes weren't from a few large whale trades, but rather many smaller trades. And then more retail participation in ETFs. I think you see, rather than using single stocks, why buy a single stock when you can invest in the entire sector? That old adage of sector investing. And then the last one, the 4th chart, is around options volumes. ETFs have options tied to them. Options can be a very speculative way to add leverage to a portfolio or hedge your portfolio. And we saw a significant increase in total options contracts. So over 3.6 billion actually of option contracts were traded in 2022. That is up from 2.6 billion in 2021. And there was a slightly more volume on the sort of put side. So perhaps a little bit more hedging, but also the fact that the ETF ecosystem has, expanded. You see more defined outcome and structured products type ETFs. Those assets have increased, and they use ETF options to create those synthetic exposures. So again, goes back to how the ETF is really a vehicle of the diverse set of users, and that flexibility I think was really evidenced with the increase in trading volumes, not just from traditional senses, but also within the options market too.
Excellent stuff. Thanks as always for sharing your insights, and thanks for joining us today.
Thank you.
So that was Matt Bartolini of State Street. Let's quickly recap some of the main tickers that we discussed. The SPDR Portfolio S&P 500 High Dividend ETF, ticker symbol is SPYD. SPDR S&P Dividend ETF, ticker symbol is SDY. Then for small caps, SPDR Portfolio S&P 600 Small Cap ETF, ticker symbol SPSM. For chips, SPDR S&P Semiconductor ETF, ticker symbol XSD. For short-term corporate bond ETF, ticker symbol is SPSB. And for 3 to 12-month Treasury bill ETF, ticker symbol is BILS. Easy to remember. For the actively managed bond ETF that he mentioned, the ticker symbol is TOTL. It is the SPDR Double Line Total Return ETF. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.